I started my channel as a live stream on the Dividend Growth Investing Group on Facebook, and I still go live at 9 a.m. every weekday morning within the group. On Monday, June 8th, I did a deep dive into Oxford Lane Capital, OXLC. This video is that clip from the show. Oxford Lane Capital. Let's start with Seeking Alpha. First impressions, the price. So in the group, we consider anything less than $5 to be a penny stock. This is a recent fall below $5 thanks to the COVID-19 crash. Looks like it fell below there on the 16th. On Monday, the 16th of March, right in the middle of the crash, bumped up a little bit higher, back up to 6 on 4.9, but it's been struggling ever since. So that's extremely short term just on price. Let's look at long term. Let's look at the price out to max. So out to the max of their data, 2011 or so, it was at 20. And it's been pretty much falling ever since. Okay? A downward trend like this tells me that the market doesn't like it. The market thinks it's worth less and less. The value of this stock as a company, as an investment, has been going down over the last 10 years. So the question is, why? Well, first off, we have to answer the question, what is this? So let's go to key data and overview. And by the way, Seeking Alpha has changed a lot on their website. Now if you go to summary pages, you'll still see this and you'll still see the news, but they've also added a number of other little sections down here, sort of previews of the other stuff, just so everything can be on one page. So here's the fund profile that you can also get to by going to Key Data Overview. Let's just scroll down here. Oxford Lane Capital Corporation is a close-ended fund, CEF, launched and managed by Oxford Lane Management. It invests in fixed income securities. Okay, what does that mean? The fund primarily invests in securitization vehicles, which in turn invest in senior secured loans made to companies whose debt is rated below investment grade or is unrated. Okay, Oxford Lane Capital, formed on June 9th, 2010, domiciled in the United States. The fund seeks to maximize its portfolio's total return. Okay, we'll test that theory. The fund seeks to achieve its investment objectives, English, hello, by investing primarily in senior secured loans made to companies whose debt is unrated or rated below investment grade, senior loans, with an emphasis on current income. Right. The fund you'll find me making little comments here every once in a while, because from the research that I've done, I can tell the hype, and I don't want to take the bait. The fund intends to initially implement its investment, blah, 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 blah. Collateralized loan obligations. This was a trigger phrase for me because I remember the financial crisis of 2008. That's when the mortgage industry collapsed because of collateralized loan obligations. CLO vehicles are entities that were formed to originate and manage the portfolio of loans. Remember the word loan, it means debt. Let's dig a little further into this without just reading. First off, let's finish what I'm talking about. Let's look at their total return because they seek to maximize total return. How has that been going for them? Not great. Here's their price return. They don't have a full 10-year history, but over 5 years, minus 72.71%. Okay, so are they keeping their promises? Total return, minus 25.57. Let's see what that looks like on a graph. Here's price going down over 5 years. Let's take it out to max because they started in January 2011. This is just price. So because they want to create a current income, that means their dividend has made up for it, right? Not so much. So price return over 5 years, and let's take it out to max. Price return is minus 77.86. And total return, which includes dividend and compounded dividend reinvestment, is at 6.87%. I don't think they're succeeding. Looks like they were doing okay. They were growing. They dipped in 16. They came back. Here's their peak and the crash. Are they trying to recover? Of course, everybody's trying to recover. But are they making it? I don't think so. Just my impression. A couple different ways of looking at price. All right. Let's look at dividends. Dividend yield, 38.57%. This is what is getting people's attention because that's amazing. That's awesome. I mean, if you buy one share of at $4.71, you'll be getting this annual payout of $1.62 every year forever, right? We'll see. Payout ratio, 96.43, is very high. This is not a real estate investment trust. They want to put their capital towards investing in new avenues, right? That's what every company wants to do. Well, they don't have a whole lot of capital to work with to buy new options or to buy new loans, or because that's their business model. This is also a red flag, at least for a dividend growth investor. Minus 8.31 over 5 years. Excuse me. What has happened over the last 5? So let's see. It's been going down. This is all dividend history. They started paying dividends as soon as they launched in 2011, and it's been going down significantly since 2015. You can see that. Minus 12.28%. Let's look at actual history. Okay. Looks like they might pay monthly, and I think they do. Or at least they do now. When they first started, 2011, 12, 13, 14, 15, 16, and 17, they were paying quarterly. And then in 2018, they switched to monthly. Not sure why. I'm guessing to make themselves more attractive to investors. Is it working? The price kind of tells a different story. This is dividend, not price, but same direction on the graph. How about yield on cost, which as a dividend growth investor, we want to be going up over time. It's not going up over time. So 1 year ago, you'd be getting 16.22. 3 years ago, if you'd bought it, you'd now be getting 14.85. 5 years, 10.19. How about going all the way back to the beginning? If you'd bought it at the IPO, your yield on cost would be 8.16. So that's not bad, but it's going in the wrong direction over time. As a dividend growth investor, as a total growth investor, that's a wrong direction alarm. And I was in the Navy, so I know what that means. I dug a little deeper. So one thing that I noticed about Oxford Lane is that they issue their own preferred shares. So this is Quantum Online, and they are a tracker for preferred shares, and they have a couple of them. So the way preferred shares work is they get paid before the common shares. So if there's a reduction in revenue, a company will pay their obligations in a certain order. Companies have bonds, and then they have preferred shares if they've issued them, and then they have common shares. And that is the order that the money goes. They go to pay the bonds first because it's a higher priority, then the preferred shares, and then the common shares if they have anything left over. So if you only own OXLC and you don't own any of these, remember that these are going to get paid first. Here's another page about them. It's a little less updated. They don't have the April or May announcements that came out that we can look at later. But there's another source. They also have their own website. So here is Oxford Funds. This is the management company. And this is Oxford Lane Capital. And I wanted to go over this overview because this gives in pretty high definition, in pretty clear graphics, what I was talking about earlier. Because they're buying senior secured loans which get paid before high yield bonds, which get paid before preferred equity, preferred shares, which gets paid before common equity. So they're investing in these, but they have preferred equity on their own stocks. I think this is a debt rabbit hole, in my opinion. Now, here's 2008. This is annual total returns for the index that they follow, I guess. 2008 was a really bad year. 2009 sort of made up for it. And here's the decade that we just went through. What else? So U.S. CLOs, collateralized loan obligations, are financing vehicles where securitization technology is applied to a diversified portfolio of primarily senior secured first lien leveraged. There's lots of buzzwords in here. Okay, so here's the ratings, and Moody's has a really good breakdown on Wikipedia if you're interested in that. All of these are broken apart and turned into CLO debt. And then Oxford Lane buys that CLO debt. And they buy a lot of it. Here's the team. And having a large team like this with executive management and investors and finance experts and operations, okay, all of these people make money. All of these people get paid, justifiably so, I'm sure. But that means that they have to get paid from somewhere. And that's the fees that they pull from whatever gains they make on the investments that they make. And that's true for anything. That I'll just be honest. Every single exchange-traded fund, mutual fund, etc., has a team of people on their board of directors with professional investors who keep an eye on everything and try to maximize the profits. That's just business. Here's a breakdown of their dividends, which we've already seen. And they have the details going back to 2011, just like we saw in Seeking Alpha. Here's something that I wanted to point out. So this was a press release that came out on May 4th of this year. Okay. While no decision has yet been made with regard to the company's common stock distributions for July, August, and September, we believe that the company's board of directors will likely elect to reduce or suspend the company's distributions for those months. In light of current economic and market conditions, specifically as a result of the global crisis caused by the spread of the COVID-19 virus, we believe that no reliance should be placed on the prospect for any particular level of common stock distributions for those months or for any other periods. So they did announce May and June distributions, payment dates May 29th and June 30th, and they stuck with their amount. But after that, all bets are off. They might, it depends on the revenue, but I would guess that it's unlikely. So if you're thinking about getting into Oxford Lane at 471, which just dropped to 469, maybe not. I know I would not. I have no plans to buy this. They also have a PowerPoint presentation that I kind of skimmed through, but if you want to dig further, because this has been 20 minutes so far, if you want to dig further into what they buy, their appendix down at the very bottom here has a nearly complete full list of all of the collateralized loan obligations that they have bought from Apollo Capital, from Jefferies Finance, Brigitte Capital, Carlyle Group, Credit Suisse, New Star Financial, which is now part of New Eagle, or First Eagle, etc., etc. Okay, so you can look up all of these companies if you want to and see what you're buying when you buy OXLC. That's the deep dive research that you can do if you really want to. Bottom line for me is the momentum. Okay? Because I look at this and I think opportunity cost. What could I have bought 5 years ago that would have been better than what I would get from OXLC? And the answer is just about anything. Especially stuff at the top of my ranking list. So, let's close all these tabs and not worry about OXLC for a good long while.